Yo, what's up, everybody? It is Friday, November 4th. How you doing? Yeah, Friday. Right on. So, it was a pretty good day today, I have to say. We had a nice rally at the close. Market tried to get hammered down a couple of times, and it came right back. I kind of like this trading action. You know, I don't like to ascribe anything medium or long term to one day's action, but this is the floor trader in me. Like, I look at how I think they should behave and how they do behave, and sometimes it could transmit some information about what's going on. As you know, I'm bullish medium to long term. I said that these rate hikes are really starting to add up into some decent size interest income transfers into the economy, and I'm going to show you something off of the Daily Treasury Statement in a minute. But it's something that is really being ignored, or I should say, in the case where it's being observed, it's framed as this terrible negative, like, gee, look at, oh my God, look at how much interest the government is going to have to pay on its debt, right? This is typical of the way these things are viewed. It's the classic, monetarist or hard money, Austrian gold bug type of mentality. Where are they going to get the money from? How are they going to do this? Which is like really silly. But what's being left out, like I always say, there's two sides to all of these things, okay? Yes, the government's interest payments are going to go up because the Fed is raising interest rates, and the government pays that like it pays everything else. It just, tells the Treasury to make those payments. It tells the Fed to make those payments out of its account, and it makes those payments, just like it makes Social Security. By the way, somebody wanted me to talk about Social Security. I'm going to do a special video, but I'll just say one thing about Social Security right now. There is no money stashed up in a trust fund, okay? This is another very misleading conversation that you hear all the time, like the trust funds. All the money collected, like in payroll checks, that's Social Security, that's FICA, that's the money that's deducted from your payroll, your paycheck. All that money goes into the Treasury's general account for all spending, okay? And that comprises like all of that stuff, that employment taxes, which that's what it is, FICA, that's Social Security, Medicare. That's 87% of all taxes collected by the government, okay? Corporation taxes are about 13%. So like when people say, oh, only, like 40% of households don't pay any tax, they don't understand that if you get a paycheck, okay, it's taken out of your paycheck. And almost 90% of all taxes come from the FICA, the Social Security and Medicare. That goes into the Treasury's general account, and that's spent for everything. It's spent for defense, it's spent for Social Security, it's spent for everything. Now, what are these so-called trust funds, the Social Security trust funds? They basically get an IOU, which are non-negotiable securities. It's like the government selling, a bond or a note to another agency of the government, and it's basically an IOU saying, yeah, we spent $1 trillion on Social Security. When it comes time to pay it back, it's not even a question of paying it back. The IOUs are always good because just like treasuries are always good. It can't be insolvent. But anyway, I'm going to do a whole other thing. I didn't want to get off course on this. I'm sorry. So, interest is being looked at as this big boogeyman, this really dangerous thing. It's like another one of these phony debt bomb things. But what's left out is the fact that it's like I've said before, it's like checks going out to the economy. Unfortunately, it's checks being sent out to people who already have money, but it all goes into the swimming pool, and some of it gets spent. And you see today, for example, the job report, very good, 261,000 new payrolls. These interest income flows, I am convinced they are supporting consumption and investment and keeping the economy on a positive growth track. And it's funny because the Fed, Wednesday in Powell's press conference, he was like, we don't see any slowdown. Like, we raised rates 5-6 times. We don't see. Yeah, well, you're not going to see any slowdown, dude, because now it's up to like the projections are like, and I said this the other day, it's like 1.5 trillion, all right? 1.4, 1.5 trillion of interest that's going to go out. You look at the 32 trillion in outstanding treasuries, we're at 4%, so that's like 1.2 trillion. It's going to go up to 5%. It's going to be 1.5. That's like a whole nother COVID fiscal stimulus. Now, here's the thing I'm going to show. Now, let me just say this, like the interest on treasuries, it's going to take a little while for that to ramp up, because remember, the treasuries outstanding, they have to mature. You got 2-year notes, 5-year notes, 10-year notes, 30-year bonds. Those things have to mature, and then new ones get issued. And the new ones, they're going to come with the higher coupon, the higher interest payments. So you're going to have that elevated level of interest payments for a long period of time after this. But what's hitting right now is interest on T-bills, right? That's every 30 days. I want to show you this. This is I clipped this out from the Daily Treasury Statement. Okay, just watch and listen to this. All right, let me show you something. This is a table from today's Daily Treasury Statement. It's table 3B1, issues. This is adjustment of public debt transactions to cash basis. It's cash and debt operations of the U.S. Treasury. Look where it says discount on new issues, okay? Right there, discount on new issues. Underneath, it's bills. That's T-bills. Yesterday, 3.6 billion. That is effectively the interest paid. Okay, it was a 3.6 billion discount. The fiscal year so far, almost 16 billion. It's huge. So you see, it's already a significant amount. We're up 16 billion in a month that's been pumped in, all right? And that's just going to keep on increasing because, it doesn't even really reflect, like right now, the rate just got pushed up to 4%, and the Fed's going to keep going now. They're saying 5%, maybe a little bit, maybe higher than 5%. The Fed could keep going on this. Now, there's going to come a point, and I've been saying this, and I believe this firmly, and maybe today is that, I don't know if today is that point, but, the way it traded today, like normally over the last, 6 months or so, if there was a strong economic number, the market would tank. You know this, I don't have to tell you. And why would I've made videos about this, about how it's totally irrational, but it's being driven by monetarist belief systems. So when they see a strong number, everybody was selling because it was like, oh my God, that means the Fed's going to raise interest rates. Oh my God, that means the Fed's going to raise interest rates. It didn't matter what it was. It could be GDP. It could be the job. We had a couple of these on jobs the last couple of months when it was really strong, and they tanked the market down. And they tried to do that today. And by the way, what also happened today, which I thought was interesting, that we did have, and I said to my friend when the market was up in the morning, I said, don't worry, we're going to get some comments by Fed officials to try to knock it down. And sure enough, we had some comments. I know Neil Kashkari, the Minneapolis Fed president, I call him Neil, we stopped going to movie theater and restaurants Kashkari. If those of you who have been following my videos, you know what I'm talking about. He said, we're going to have to go way higher than we thought. And there was another Fed official. And these comments, they had some initial negative effect. But at the end of the day, the market rallied. The other thing I want to point out, check out the dollar. The dollar got hit pretty hard today. And my hypothesis is that we are starting to see an expansion in the leading spending flows of the federal government for the first time, really for the first time since May. And these leading flows being driven by interest income flows. I mean, when you start to expand fiscal, what happens? It's bearish for the dollar. And it's interesting because the dollar, and I sent out a chart. I can't put it up here right now, but the dollar is tracing out a pattern very similar to the pattern. I chart the daily spending flows. So I know exactly what it looks like graphically. I know exactly what the numbers are. And the patterns are very, very similar, only inverse. In other words, spending's going up, dollar's starting to slink down. So keep your eye on that. Anyway, that's it for today. A little bit of a short video, but it's Friday. I want to go have some fun. Anyway, take care, everybody. Have a good weekend. Bye.